Welcome to our latest podcast. I'm Derek Barrow from Santander Asset Management. I'm joined once again by our Global Head of Macro, Tactical Asset Allocation and Alpha, Haydn Davies. Good morning, Haydn.
Good morning.
Okay, so let's kick off. Bond markets have had a really difficult time over the past few months, but have since recovered a little bit in November. Have bond markets now turned, and what are the prospects for bond investors?
Well, certainly bond markets have attracted more than their usual share of headlines in the newspapers, I guess, in the autumn, because, as you point out, bond markets have sold off quite a little bit since the summer. In the US, for example, we saw US 10-year yields reach about 5% compared to about 3.5% in the spring, early summer. And don't forget, of course, when yields go up, that means that prices are going down. And in the UK, we saw gilt yields didn't quite reach quite as high levels, but rose to about 4.75% in October, compared again to about 3.5% a little bit earlier in the year. Since then, as you point out, bond markets have recovered a little bit. And let's put this in context, of course, that obviously last year we saw bond markets sell off about 15%. This year they had managed to eke out some modest gains, and they've reversed that. All against the background, quite surprisingly, of course, of inflation noticeably moderating, and central banks making it quite clear that they have pretty much come to the end of raising interest rates. So it's quite surprising that against that background that we've seen bond markets sell off when the news has been generally pretty good. Pretty good on the inflation front, on the interest rate front, normally news that would actually support bond markets and actually help bond investors. And of course, the sell-off that we've seen in bond markets isn't just bad for bond investors, it's bad for issuers. So in the UK, for example, every 1% rise in the gilt yield increases the government's cost of borrowing, its cost of servicing the debt by about 3 billion. So this has real consequences, not just for investors, but for taxpayers and governments as well. Because the news has been good, our view would certainly be that we think that perhaps bond markets have overreacted. Central banks, by and large, have paused for 2 meetings now. I think that's the case in the US, in the case in the UK, and the ECB. They've made it quite clear they don't expect to have to raise interest rates any further. But the message, and this is the reason really why the bond markets have sold off, or one of the explanations at least, is that the message that central banks have been giving is that, well, we think we're done for now, but we aren't about to start cutting interest rates anytime soon. And the message that keeps getting peddled and repeated is higher for longer. So do not expect interest rates to be cut to the levels that we got used to over the last 10 years. Interest rates are going to stay at roughly these levels for quite some time. So 5.25% in the UK, 5.5% in the US, and 4% in European Union. And that message, even though central banks have been repeating it over and over again for quite some months, finally got through to bond markets, and that came as a little bit of a shock. At the same time, we've seen governments increase their issuance. So even though the US economy has been doing very, very well, the government deficit in the US is about 6%, which is pretty much unheard of, given that we've got very low unemployment. So governments are issuing more bonds. So they're borrowing quite heavily. The UK deficit's about 5%. And that has added fuel to the fire. So if governments are issuing more debt, that generally pushes upward pressure on bonds. However, we do think that given that central banks have come to the end of the interest rate cycle, inflation is peaking. So US inflation is now 3.7%. If you remember, it peaked at about 9% in June last year. UK inflation, as everyone knows, it hasn't been falling quite as quickly as in the US or the European Union, but it's 6.7%, which is just be lower than its peak of 11% last October. That that trend should continue. We don't expect inflation to be falling as quickly as it has been, but by and large, we should be at inflation rates of about 2.5% by the middle of next year. That should be good news for bonds, and that should enable central banks maybe to start thinking about cutting interest rates by next summer. So we do think that bond markets have overreacted. It's not as if central banks, by keep repeating the message that interest rates will be higher for longer, have really given us any news. We've known that for quite some time. They've been saying it pretty much since the spring. So we do think the bond markets have overreacted, and these yields, we have bond yields now finally, or for the first time in a couple of years, above inflation. So basically, bond investors should be making inflation-beating returns. And of course, there's always the upside that if growth turns out weaker than expected, and central banks, or indeed if inflation falls more quickly than expected, central banks start cutting interest rates, that would be very good news for bond investors. So there's a lot of upside at these levels. We think these are pretty fair levels given the outlook for inflation and growth. So it should be a better outlook for bond investors than we've seen since the summer. And that, because that's perhaps one of the reasons why bond markets have rallied a little bit since October. Helped by the reassuring notes from the central banks that higher for longer means exactly that. It doesn't mean higher for longer and maybe we'll raise interest rates a little bit more as well. So it should be a better outlook for bond investors. And we've been saying that for a little while, that bonds looked attractive at these kind of yields, but you weren't necessarily going to miss out if you didn't buy now. We're now getting to the point where now that interest rates have peaked, this probably is the time, though, the best time to start investing in bonds and topping up those holdings.
Excellent, thank you. So moving on then, the US economy has confounded forecasts of a slowdown this year and even accelerated in the third quarter, while the UK and the Eurozone have stagnated somewhat. Can the US economy keep growing so strongly, or will the European and UK economies turn the tables, accelerating while the US slows down?
Well, can the UK and Eurozone take over from the US? That's quite a question. Perhaps we'll come back to that in a second. As you point out, the US economy has been going absolutely gangbusters, particularly in the third quarter. So in the third quarter, the US economy grew 1.25%, which is almost as much as we would expect the US to grow in a normal year, given productivity growth and population growth. And it's about as much as the UK will, well, it's more than the UK will grow this year and next year put together. So that's in one quarter alone. So the US economy has been on fire. And at the start of this year, economists expected the US to grow maybe about between a quarter and a half of 1%. And now we think the US will grow about 2.25%. So the US economy has done much better this year than anyone expected, and yes, extraordinarily well in the third quarter. Now we don't think that can be sustained, and certainly, although it sounds like good news, of course, strong growth makes it harder for the US Federal Reserve to bring down inflation. And we don't think that it will be possible for the Federal Reserve to bring inflation fully down to its target unless the US economy does slow. But of course, there are good reasons to think that the US economy will slow from these levels, because that extraordinary pace of growth in the third quarter is exceptional. So in the fourth quarter of this year, one of the reasons why the US economy will slow will be that students will have to start paying interest and servicing their student loans. So they've basically been forgiven servicing their loans since COVID, and that's going to have a noticeable impact on consumer spending. At the same time, the reason why the US has been doing so strongly has been consumer spending has been very strong, and government spending has been very strong. So the US deficit at 6%. There are reasons to think that certainly government spending won't be as strong going forward, and coupled with students having to service their debt, that will take some spending power away from consumers. And at the same time, one of the reasons why consumer spending has been so strong has been that consumers in the US, just like everywhere else to some extent, have basically been running down the excess savings that they accumulated during COVID. So during COVID, governments were very generous in their support, and consumers managed to sort of tuck away quite a bit of savings under the mattress, and they've been running that down ever since. And it looks as if we sort of got to the levels of savings now where perhaps most consumers have run down their excess savings. So certainly this year has been great for the US, but looking forward, economists expect weaker growth certainly in the fourth quarter and through next year as well. And in the case of the Eurozone and the UK, it'd be great to think that while the US slows, the UK and the Eurozone could accelerate, but that doesn't look very likely at the moment. So Germany and the UK may already be in recession, and growth in the Eurozone, the UK is expected to be about, well, less than 0.5% this year, so compared to 2.3% in the US. So very weak growth this year in the Eurozone and the UK, and that's expected to continue, as the Bank of England highlighted in its recent monetary policy committee meeting. And really, the reasons for that are still the impact of higher interest rates. Bizarrely, interest rates don't seem to have had quite a full impact in the US. Partly because of idiosyncrasies in the mortgage market and the like, and also just generally a lack of investment by companies. So unfortunately, it doesn't look as if the UK and the Eurozone are going to accelerate whilst the US slows down, a much needed slowdown, I should point out. But at least, I suppose, if you're going to point to a silver lining there, that at least that should make sure that inflation does come down to the Bank of England's 2% target. So unfortunately, sort of not a great outlook for the UK and the Eurozone. Unemployment is rising in the UK, has been for about 6 or so months, and that's expected to continue. The US will slow, it has to slow, but certainly not looking like a recession at the moment. Economists are talking about a soft landing, but certainly weaker growth from the US, but unfortunately not stronger growth in the rest of the world to compensate.
Excellent. Thank you for, once again, a comprehensive answer. So looking forward now, after the recent bond market turbulence, what are the prospects for markets as we end the year, and can investors look forward to a Santa rally?
A Santa rally, I'd be delighted to offer investors that outlook. Santa rallies aren't actually that normal. So Santa rally, for those who don't know, is generally a rally as we lead up to Christmas. So often in sort of the first, second weeks of December, and then basically investors take a much needed break. I mean, it's possible that we'll see markets rebound, continue the rebound. So following the sell-off in bonds, that dragged down equity markets in the summer and through most of the autumn as well. Bond markets have recovered. That's helped equity markets. So there is the possibility, but at the same time, the background certainly doesn't suggest that we're going to get a strong rally looking into next year. And indeed, we're a little bit cautious on the outlook for equities. So companies are being a little bit cautious in their advice on their profit outlooks to investment analysts. So investment analysts are downgrading profit forecasts. So that's not a great backdrop. Growth will be weaker in the US over the next 12 months than it has been over this year, and growth will continue to be weak in the Eurozone and the UK. So those are reasons to be cautious, certainly about equities. As far as bond markets are concerned, well, caution on equities is one reason to be positive on bonds, because a weak equity market will probably be good for bond investors. And at the same time, inflation will continue falling from its current rates. It should reach about sort of 6.7% currently in the UK. It should reach about 4.5% by the end of the year. and then continue falling to about 2.5%, and that's good news for bond investors. So we're a bit more upbeat on the outlook for bonds than we are for equities. We don't expect a dismal period for equity investors. We're not forecasting a recession in the US. We're not even forecasting recession in next year in the Eurozone or the UK. So that should be a backdrop that's reasonable for equity investors. But just at the moment, we're not quite sure that the timing is right to be a little bit more positive on equities. So unfortunately, we don't expect a Santa rally, but certainly we're not expecting a Santa sell-off either.
Thanks, Haydn, for such a detailed update. Thank you for listening to our latest podcast. The views expressed in this podcast are the views and opinions of Santander Asset Management UK and do not constitute investment or financial advice. If you want to explore more of our views and insights, please visit our website at santanderassetmanagement.co.uk. If you require advice or guidance, we would recommend you contact your professional advisor. Thanks once again for listening to the podcast, and we look forward to speaking with you again soon.